Hi, it's James from the Chart Guys. It's September 20th on a Tuesday. I am doing a personalized technical and fundamental analysis of gold for Dr. Gregory K Lee. Um, I sent him an original video, but it did not go through to him, and now I cannot find it. I probably deleted it to make space on my hard drive. So in 2002, you see that gold was trading at uh, under $300 an ounce here. And over the span of 9 years to 2011, it hit a high of $1,923 at a peak. Incredible, incredible gains over that period of time. And then what happened is gold hit a bear a bear period, and it went down. And currently, it is setting to start a new bull bull run. And why is it starting to start a bull run? And what is the timing on that? So in 2015, Bob Ryan, who's a pretty good analyst for Business Insider, he said on July of 2015 that this was one of the longest gold bear markets on record. Yeah, there have been longer ones, but this is probably, I think this is the fourth longest ever in history that it went on from this period to this period. And that was back in July of 2015. So boom, he timed it perfectly, and we started a new bull market here. Um, Now you can see with bull markets, they don't go straight up. You want them to go up, sideways consolidation, consolidate. And the reason why is that um, bulls tire. You can't just keep buying. You're not going to keep buying, bring new buyers in to buy. So what you want to do is you want to buy. People are going to take profits, but you just want the price to hold up, the demand to still be there, and you want new buyers to come in. So we've had this move up, uh, sideways consolidation. We had this move up. I got you into gold, probably the recent gold positions, probably around here, because I didn't think it's going to consolidate that much. I thought it was going to consolidate like this, um, but it's prepping for a move up again. And the reason I can kind of predict that is the history of the price movements. So these white arrows are on big green candles on gold, on these big spikes. And what those were economic data by FOMC, Federal Reserve, or this was Brexit, this was bad payroll numbers, this was FOMC, the Federal Reserve, saying they're not going to hike rates. This was um, Federal Reserve saying they have to wait for data to hike rates. And tomorrow, Federal Reserve meets again. And you can see the chart historically is setting up the same way. Um, all these red days forming a base, all these red days forming a base, red days forming a base, kind of flattening out. Same way here. And what you notice on these pullbacks is you see this volume declining. This is volume. This is how much buying is coming into it or selling is going into it. So the volume is decreasing as the price going down. That means not many people are giving up their shares. And then you see this volume spike on a green candle, which means people are buying into the strength of it. And then you can see the volume go up as the price moves up, which means people keep buying it. And again, a decline after the peak in volume, but not much selling, and then a boom, another volume. So it's setting up the same way. We're seeing this volume decline, and it's setting up for another big move. So I think it's consolidated all it's going to consolidate on the daily and the weekly. It looks like it's ready to make a move up. And you can kind of draw these channels here of breakout. So we have this channel here. We have this channel here. So we should see gold bounce here, go for the high of this channel, and then break out higher for a continuation to the upside. And what these are called are bull flags, where you go up, move sideways consolidation, up, sideways consolidation. Um, and why do I believe that there's a lot more upside to gold is because of how gold moves in historically in gold bull markets. So these are different lengths of the bull markets. This one was an 8-year market. This was a shorter market, 3 years. This was a 4-year, 8-year. This was 4-year. But obviously, a lot of these dates run in together, and you saw the little tiny pullbacks. But so it's only been 1 year since we've started this bull market. It started in January. So at worst case scenario, we still have 2 years to go. So we're here at about 200% gains in gold, and historically, in the next worst case is we gain another 150% in gold here, and obviously you can see the exponential gains that are possible in gold in a gold bull market. The way I've invested for you in gold is what we call gold miners, and it is called JNUG. And JNUG is a ETF, and what an ETF is, it has different stocks in its portfolio. There are different mining companies that hold different percentages inside that portfolio, so that all your risk is not in just one gold mining company. And gold had that big move, but look at the move that it had a $100 move, no, a $200 move from. Let me see. Let me just double check. So gold had a move at the start of the new bull market at the low of 1,045 and the high of 1,320. So a $300 move in gold. Not even double the gains, but look what it does to gold miners. Gold miners started at the beginning of the year at $2, and then it went to a high of $32, almost $33. So the gains are exponential. So I did get you in a little late here, and it did pull back more than I expected, but it's forming a base again, similar to the other times it's blasted off again. So I'm expecting a big move up again here with gold after this FOMC meeting and whatnot. And the reason why people are so scared of interest rates is because they think it brings down gold, but that's not historically true because the federal government raised interest rates back in December, and this is when they raised rates. And look what gold did. That's the miners thing. Let me see. Look what gold did after the federal government raised rates. It didn't affect them, and it went higher and higher. And the reason that is because a lot of countries, as U.S. dollar goes up, their currency weakens. And with the world economy being much weaker than the U.S. economy right now, their currencies are suffering against ours. So what other countries do, like China and Russia, is they buy gold as a hedge to U.S. currency. And so if you look at some fundamental data, China and Russia have been buying tons and tons of gold to hedge against the U.S. So that's my thoughts on gold and where it's headed. Let me see here. Let's close all this. This is another chart of currently where we're at. Again, historically, gold bull markets last year's, and we've just barely started hitting the stride to go higher here. Other stock I have you in is SVXY, and what that is it's a fear stock. What that means is, as fear goes down, the higher the stock goes. And as you know, no matter what, the stock market keeps going up historically. And so it's the opposite of UVXY. So UVXY at one point was trading at 2 million. What is that? $2,448 a share, and currently the price is at $20.59. And the reason why the discrepancy is prices, it's called a reverse split. When stock prices get too low to like pennies, they'll package like 50 stocks and make it one stock to make it a more higher price, because no one's buying a 1 penny stock. They'll put like 100 stocks together and make it $1. And so UVXY keeps decaying, and XVXY over time is meant to go up, and it's pulling back a little bit, but it's meant to keep going up because volatility will never keep going up. It's based on VIX, the volatility index, and if you look at the volatility index over time, it spikes sometimes, but for the most time, fear stays pretty relative. So that's the other stock I have you in. Finally, I have you in natural gas, and the reason I got you into natural gas is because this is the weekly and the long term. Long term, it's been bearish, but what's happened is that natural gas has tried to change the trend just like gold. It's starting a new bull market. It started this year, and it had this strong downtrend resistance where the price couldn't get above it, but now the price is has gotten above it on increasing volume. Increasing volume is a very strong indicator for which way the stock's going to move. If it's a green candle, bullish, and a big green candle with increasing volume, that's a very bullish move. So anyways, that's the main positions I have you in. I also have you in an oil position, CWEI, and I got you into CWI this year, a little bit late too. I got you into CWEI about right here at like 60, probably like 60 some, low 60 some dollars, and you can see how much strength it has. The reason why I got you into oil positions is on January, someone put in a $1.6 million bet. That's probably a hedge fund that knows something that oil is going to go higher up into January. And what an option is they're betting on $1.6 million that oil goes up. If they hit that bet, then they make a ton of money. If they miss that bet, unlike stocks, they lose it all. So most hedge funds won't make bets like that unless they know something. So they probably have insider information. And then I have you in Vuzi. Vuzi is a virtual reality company that is picking up steam with all the new VR technology, the way they're using it in medicine and things like that. So you can see the strong uptrend. And another reason I got you into Vuzi is because Intel Corporation owns 20% of Vuzi, and there's rumors that Samsung wants to also buy out Vuzi. And when stocks get bought out, they multiply like 2-3 times. Keurig is a prime example of that. This is what happened to the stock price in Keurig once they got bought out. It may take some time for Vuzi to get bought out, but look what happened to Keurig. It went from $53 to $91 in one night. That's what happens when companies get bought out. Another company that got bought out recently is LinkedIn. One night move, they got bought out by Microsoft. One night move went from 135 to 193. So that's why I have you in Vuzi, just because of the potential technology for the future, and also knowing that Intel has a 20% stake and Samsung wants to also have a stake in them. So review the video, let me know what you think, Dr. Lee, and get back to me.